Right friends, welcome back to Know About Insurance. This is fourth module. We are going to discuss about insurance ombudsman and key terminology. Just like banking sector, insurance sector has also got ombudsman. All of you are well aware, in banking sector, Reserve Bank of India appoints the ombudsman. But in insurance sector, it is slightly different. This institution of ombudsman was created on 11th November 1998 by the Government of India, and at present 12 ombudsmen in the country are working with their respective territorial jurisdictions, and the institution of ombudsman is for quick disposal of the grievances of the insured customers, basically with a view to protect the interests of the customers. And who will appoint this ombudsman? Ombudsman will be appointed by the governing body of Insurance Council. The governing body of Insurance Council. You may ask, what is governing body of Insurance Council? This governing body of Insurance Council consists of representatives from insurance companies. And this governing body of Insurance Council issues orders of appointment, but it is based on the recommendations of the committee consisting of IRDAI chairman, LIC chairman, GIC chairman and a representative from central government. So, based on the recommendations of IRDAI chairman, LIC chairman, GIC chairman and representative from central government, the governing body of Insurance Council issues the order of appointment for ombudsman. Then there are three categories from which this insurance ombudsman is to be selected. The three categories are insurance industry, civil services and judicial services. Other important point is the person will be appointed for a period of 3 years or till he attains the age of 65 years. So, these are the stipulations imposed by the Government of India while giving order on 11th November 1998, and the cost of ombudsman or the expenses for the offices of ombudsman and their staff are to be borne by the insurance companies only. And the second important point is the maximum award a ombudsman can give is rupees 20 lakhs. What is the procedure? Just like banking system, there is a well laid out procedure here. One is, first of all, you have to apply to the insurer if you have any problem. Don't confuse between insurer and insured. If X has taken insurance policy from LIC, LIC is insurer, X is insured, and wait for 1 month for getting the reply from insurer. Let us say LIC, wait for 1 month, or prior to 1 month LIC has given reply to X, but the insured is not satisfied with the reply. So, within 1 year of getting the reply, or within 1 year after waiting for 1 month for getting the reply from insurer, so within 1 year one can approach ombudsman. By writing, one can approach ombudsman within 1 year after waiting for 1 month from the insurer, or within 1 year after getting a reply from the insurer. And the complaint can relate to repudiation of claims by the insurers. There is some dispute with regard to the claim, some fire accident occurred, some theft occurred, but there is a dispute between insurer and the insured. Then for this repudiation of claims by the insurers, people can approach ombudsman. Second thing is dispute with regard to the premium paid, then also can approach ombudsman. Then dispute with regard to the legal construction of the policy wordings, then also we can approach ombudsman. And delay in settlement of claims, then also we can approach ombudsman, right? So, these are the circumstances under which people can approach ombudsman. And once we approach ombudsman, there are two options for ombudsman. One is conciliation, second one is award. The First option is Ombudsman will try for some mediation or conciliation. In this case, what Ombudsman will do? Ombudsman will make a recommendation to the parties within 1 month. Within 1 month, Ombudsman will make a recommendation to the parties for settling the claim. That is conciliation or mediation. Then if the insured, that means who has complained, that is insured, he is the complainant or the insured. If he accepts within 15 days, then the matter is treated as closed. If it is not possible to settle the claim through conciliation, the other option is award. Then the Ombudsman will pass an award within 3 months, and the award is binding upon the insurance companies. That means it is binding on the insurers. But if the insured, that is complainant, is not satisfied, he has several other options like consumer forums, courts of law, etc. So this is the procedure laid down for the Ombudsman under insurance sector by the Government of India. Right? Here the most important points are who appoints Ombudsman, that is governing body of Insurance Council, but based on the recommendations of some committee. And the second point is these are to be drawn from insurance industry, civil services and judicial services, appointed for a period of 3 years only, or 65 years is the maximum age, and 12 Ombudsmen are working in the country, and maximum award is 20 lakhs. The expenses are to be borne by insurance companies, and we have to approach Ombudsman within 1 year, and Ombudsman can try for conciliation and award, and Ombudsman has to publish the award within 3 months. Right, friends? So these are the details about Ombudsman, and now let us look at the key terminology. We have already discussed the difference between insurer and insured. LIC is insurer and person X is insured. This terminology please don't forget. And if you look at the lapse and reinstatement, what is the difference between lapse and reinstatement? Some X has taken policy for 20 years. X has taken policy from LIC for 20 years, but X stopped paying after 5 years. He has to pay regular premium every year, but he failed to pay regular premium after 5 years, then the policy will lapse. So, let me tell you once again, if the person failed to pay the premium, the policy will lapse, and if it is brought back into force again, that is reinstatement. So, these two terms please don't forget, lapse and reinstatement. Look at beneficiary. What will happen if person X has taken policy from the insurer, LIC is insurer, person X is insured, and he died after 8 years. Then the nominee will get the death benefits. The nominee will get the death benefits, and they are loosely called beneficiaries. If a husband died, wife will be the nominee. Not only nominee, she will be the beneficiary also. So, this nominee and beneficiary are the terms which are used loosely. There is a small difference between these two, but for our discussion sake, please clearly understand each policy will have nominee, and if something happens to the insured, then nominee will get the death benefits, which is popularly known as a beneficiary. Right? So, nominee and beneficiary are interchangeably used, but technically speaking there is some difference, but I am ignoring for the time being because it is not required for you. Please understand, if insured dies, then the death benefits will be passed on to the nominee, loosely known as beneficiary. Right, friends? Look into the next one. Assignment. X has taken the policy, X is insured, LIC is the insurer. X has taken the policy, and X through assignment can transfer the proceeds of policy. That is assignment. Assignment is the legal transfer. So, the policyholder or the insured can legally transfer the policy to Y. That is known as assignment. That means through assignment, proceeds of the policy can be transferred by X to Y, then what will happen? If X dies, the money will go to the assignee. That means instead of a nominee, the money will pay to assignee if the policy is transferred legally through an assignment. So, if someone asks what is assignment, assignment is the legal document where the proceeds of policy can be transferred by X to Y through endorsement on the policy document or as a separate deed, right? So, if assignment is there, then legally the policy proceeds are transferred from X to Y, right? Look into the next one, coverage. Coverage means what is the scope of protection provided under the contract of insurance. You can say the risks covered. If you are taking the policy, you are a shopkeeper, you are taking policy, then the policy document will clearly say whether the risks covered are for fire or theft or some other damage. So, the damages or the risks covered under the policy are clearly mentioned, that is known as coverage. Then grace period. Grace period is policyholders are expected to pay premium within due date. Suppose the due date is March 15th, policyholders are expected to pay premium by March 15th. But however, beyond that period, some grace period is allowed for payment of premium. That is normally 30 days, up to 30 days you can say, that is the grace period which is allowed for payment of premium. So, during that period also the policy will be in force. So, the grace period is the period which is allowed to make payment of premium, right? And depreciation. Depreciation is the reduction in the value of property over a period of time due to wear and tear. You have purchased a new house. The house is 15 lakhs of rupees. By next year, its value may reduce to 13 lakhs. After 5 years, its value may reduce to 10 lakhs. Similarly, you have purchased a new car, originally 10 lakhs. After 1 year, the value may be 8 lakhs. After 5 years, the value may be 3 lakhs. So, the reduction in the value of property over a period of time due to wear and tear is known as depreciation. Then life assured, it is the person whose life is insured by an individual life policy is called life assured. If X is taking a life policy from LIC, X is known as life assured. If you look at the maturity, maturity is the date upon which the sum assured of a life insurance policy is paid to the policy holder. That is known as maturity. That means if the policy period is 20 years, if you are taking policy on March 16th of 2016, then the policy will be matured. That is known as the maturity date. If you have taken endowment policy, you will get maturity benefits. But if you have taken term policy, you will not get any maturity benefits, whatever we have discussed in the previous modules, right? Maturity claim. The payment to the policy holder at the end of the stipulated term of the policy is a maturity claim. So, maturity date is the date on which the agreement between the insurer and the insured ends. Maturity claim is after the maturity period, or you can say after the contract period, or you can say after the agreement between insurer and insured ends, then maturity claim will come. Whatever is promised by the insurance company will pay that amount to the insured once this term of the policy is over. So, maturity time is the time up to which there will be an agreement between insured and insurer. Once the period is over, then maturity claim will come. So, as per the terms and conditions of the insurance policy, insurer will pay insured the maturity amount after the maturity date. Right friends? Look at the next one, risk. Risk is the obligation assumed by the insurer when issuing a policy. The risk is assumed whether it is for earthquake, whether it is for floods, whether it is for fire, whether it is for theft. That is clearly mentioned. So, that is the obligation assumed by the insurer, that is insurance company, when they are issuing a policy. Nomination. Nomination is the act by which the policy holders authorizes another person to receive policy monies, right? So, here nominee will receive the money in the capacity of trustee only, what we have learned in banking classes. Vesting age. Vesting age is the term associated with pension plans. In pension plans, what will happen? Vesting age is the age at which the receipt of a pension starts. Pension plans combines both insurance and pension, and after certain age, the pensionary benefits will be given under pension insurance policies. So, that is known as vesting age. Then look at the surrender value. Surrender value is, let us take an example, X has taken policy from LIC. And the original term of the policy is 20 years, but the policy holder decided to terminate the policy after 12 years. So, the value payable to the policy holder in the event that the policy holder or the insured decide to terminate the policy before the maturity of the policy. Here the maturity period is 20 years, but X decided to surrender the policy after 12 years. Under those circumstances, how much money will be paid by the insurer to the insured is known as surrender value. Actuaries and underwriters, these two terms are very important. Actuaries means they are just like brain in human body, and they help design and price insurance policies. The persons who are conversant in economics, then analytical skills, mathematics, and who can assess various tools pertaining to risks, they will be assigned this important role of actuary, and they are the persons who set guidelines for each risk class and category. So, each risk category and how much should be the premium and what type of risks will come into picture. If it is to take care of earthquakes, how much risk is involved? These calculations based on analytical models will be drawn by actuaries, and this is a very important subject of insurance. And broadly, please understand, actuaries help design and price insurance policies, and they set guidelines for each risk class and category depending on economics and various mathematical and analytical models, right? So, this is very important as far as actuarial science is concerned. Insurance sector and actuarial science are closely related because the risk involved in insurance is to be decided based on various analytical models. And underwriters are basically the category to decide each customer falls into which category. The table or a matrix is created by actuaries. Actuaries create a table or a matrix, but underwriters will decide the category in which each customer is to be placed. And underwriters look at the data of individual customers and they decide in which risk class a customer falls, right? So, they also decide how much coverage a client can be given and how much premium. right? So, this is the basic difference between actuaries and underwriters, and these two terms are associated with insurance. Please don't forget. So, let us conclude fourth module, and please do join for last and the fifth module. Have a nice day. Thank you.